Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1394A, and today's date is October 6, 2017, and the title of the episode is, Did the BLS just manipulate the wage data? Now, before I get started, I just want to make an announcement. I uploaded an interview with Charles Hugh Smith, so all you need to do is go over to the X22 Report Spotlight YouTube channel, and you'll find the video there. Or you can come over to the X22Report.com site or newssentinel.com. Scroll down, look over to your right-hand side, you'll see the video there, and you can play it right on the site. Or you can go to Steemit, and that is steemit.com/@X22Report. The video is also on Steemit, and you can play it right on the site. Let's get into the economic collapse financial news. Now, economists, as they're looking at the United States, Europe, UK, and many other countries, they're trying to figure out why the economies are starting to deteriorate. Why aren't they doing as well as they should if we're in this fantastic recovery? Why are we seeing different countries basically implode on themselves, and why are we seeing retail fall apart, GDP fall apart? And they're trying to figure out why all this is happening. And what's very interesting about all of this, they always beat around the bush and they never go right to the heart of the matter that the central banks, they're the problem. They're putting countries into a huge amount of debt. And as you keep piling on the debt and asking for austerity, guess what happens? The economy doesn't do as well. And when people can't find jobs, it makes the situation even worse, which then leads into decline in retail, the decline in housing, decline in GDP, and it's just a snowball effect. Out in the UK, productivity, well, that has fallen, and the economy is lagging right now. Output per hour fell around 0.1% in the 3 months through June, and they're trying to figure out why this is all happening. Why is this happening out there? And here in the United States, we can see the same thing is happening. The economists are trying to figure out, why is this all happening? Now, when we use common sense and we track everything day to day, week to week, and we look back over the years, we can see that slowly but surely how the central bankers destroy an economy. And we've been watching the economy here in the United States, and we're watching it how they destroy it, and we can see exactly why these things are happening. Right now, the U.S. consumer comfort, that has plunged the most in 13 months. Americans' confidence suffered its biggest weekly setback in more than a year, and people are not optimistic about their personal finances. And what we're seeing is that the buying climate is deteriorating right now. People are looking at the economy, looking at their funds, looking at what they have, and they're saying, you know something, we just don't have the funds to do this right now, and especially those individuals that are losing their jobs. Now, the payroll information, the unemployment information came out, and we can see that the unemployment numbers, they have dropped to about 4.2% right now. Again, we've been watching this for a very long time. We know it's completely manipulated, and we understand that they're trying to make the economy look really, really good before the whole thing falls apart. And if you look back in time, the unemployment rate drops the same exact way right before a huge, major recession. And this is what we are seeing right now. And what we're seeing is that something very interesting happened. The hospitality sector, well, those jobs, they just completely imploded. They dropped by something like 111,000 jobs here, and that is just awful. And they're trying to explain away why the unemployment rate has fallen, why things are looking good, even though the hospitality jobs have dropped off. They're saying that we're getting all these full-time jobs. And once again, they are playing with the numbers. They're revising. They're making everything look a lot better than what it really is today. And we can see right now, when we look at the data and we look at what the BLS is throwing out there, they always go by the U3 number, and this is seasonally adjusted. They go back, they make a lot of revisions, and they make it look a lot better than it really is. But what we're seeing right now is the BLS might have been caught fabricating wage data. Now, this is the most closely watched statistic in today's payrolls report. The BLS reported that the annual increase in average weekly earnings was a whopping 2.9% above the 2.5% expected and above the 2.5% reported last month. On the surface, this was a great number. The 2.9% annual increase, whether distorted by hurricanes or not, was the highest since the financial crisis. However, a huge problem emerges when you look at this just 1 month prior at the revised August data. Now, Andrew Zatlin of South Bay Research noted that the total private average weekly earnings, this line posted another solid increase of 0.2% month over month, an upward revision from the previous month's 0.1%. And when you look at the components, it becomes clear that the BLS fabricated the numbers and they might have just simply hard-coded this number into their spreadsheet with the intention of goal-seeking a specific number. Now, what it shows is that whereas there are a sequential decline in the average weekly earnings for goods producing and private servicing producing industries, which are the only two subcomponents of the total private line, of negative 0.8% and negative 0.1%, the BLS also reported that somehow the total of these two declines was a 0.2% increase. Now, when you look at this, it's impossible because the two subcomponents of the subtotal decline with the total increases, the math just doesn't work out. And Zatlin notes that this is completely impossible unless you hard-coded something in there to give you a specific number. And this is what they have done. Now, they've contacted the BLS seeking an explanation for the fabrication of data. Now, if they're fabricating this data, you bet that they're fabricating other data. And there's many people out there like John from Shadow Stats, where he looks at the numbers and does the calculations and shows that, yeah, these numbers are manipulated. This is the real unemployment, and we're north of around 22% right now. We are nowhere near 4.2%. Again, we have to understand how they do this. They count part-time jobs as a full-time job. So if somebody has two part-time jobs, it's two full-time jobs. Those people who have given up and have not been on an interview within something like 4 weeks or so, they're counted as fallen off, and they're just not looking. And there's many other variables that go into this that they use to manipulate the data, the revisions and everything else. So we can see right now they are completely fabricating everything just to keep the illusion alive. Now, we can see the housing market is falling apart very, very quickly. Home sales in the greater Toronto area, they plunged by 35% in September compared to a year ago. Now, the plunge in volume was pretty much spread across all types of homes. Detached houses, negative 40%. Semi-detached houses, negative 30%. Townhouses, negative 34%. Condos, negative 27%. And when you look at this, you can see that things are rapidly changing, because if you use Zillow, which is a Canadian real estate site, they're saying that the housing prices, they are dropping. And the greater Toronto area is down around 17% from the April peak of around 800,000 to 665,000 in September. Why is this happening? Well, we discussed this before. The flow of Chinese money, it's basically fallen off because the Chinese are now investing in their Belt and Road system, the Silk Road. And they're taking the companies, the investment companies and investors, and telling them to take what you're going to invest and invest it in the Belt and Road. And we can see right now this is going to hurt the real estate market. Remember, the individuals in these countries, they're sitting on the sidelines because many people can't find jobs. Many people don't make enough to pay for these type of homes. And this was all being done by hedge funds, investment companies. They were being done by foreign entities. And we can see that this is holding true once again, because as the Chinese pull back their funds, we can see the housing market is taking a hit. Can you imagine if interest rates tick up just a little bit and hedge funds and investment companies decide, you know something, we're not purchasing homes? What do you think is going to happen to the housing market? It's going to come crashing down. Now, just a couple months ago, maybe even 8 months ago, Vancouver, Toronto, these were like, oh, look at the houses there. It's never coming down. The housing market's going to continually move up, 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 and up. And all of a sudden, we see things are starting to rapidly fall apart. Now, we've also looked at pensions here in the United States, and we know there's many different areas where they're having problems where They're completely underfunded. And we can see right now in Illinois, there's a problem. We can see Kentucky, there's a problem. And Stanford, there's another problem. And if we look, there's a map of all the different municipalities where there's going to be major problems with pensions, with municipalities maybe going bankrupt. We see Chicago is a problem. Houston is a problem. We see Baton Rouge is a problem. Fort Worth, Oakland, Phoenix, Jersey City, Pittsburgh. I mean, these are a lot of different areas where there's going to be a huge amount of problems. Now, in most of these areas, the only way you can get around this is maybe to have like a 30% tax hike or a 76,121% increase in worker pension contributions to fix many of these problems. Some are higher, some are lower, but we can see that they are in a huge amount of trouble right now. And if you're in one of these areas and you're looking for a pension, you might want to look into this to see what is really going on and do they really have the funds to pay out over that specific period of time. Now, something very interesting with the Fed. We know that the second in command, Stanley Fischer, he resigned. And he resigned unexpectedly from the Federal Reserve. And many people were scratching their head, why did he do this at this point in time? Well, when we look back in time, we can see that there were other central bankers that resigned right before something hit. And Stanley Fischer was on Bloomberg TV, and he says he's expecting higher inflation, which is going to hit very soon. He said, I still believe we will have higher inflation. Now, when you look at this and you hear what he's saying, you can see that we're heading to that point, and we discussed inflation before, where a lot of the Fed houses, they're saying it's running at 2.9%, 3%, and we know they've been offshoring or putting the inflation and stuffing it into the stock market, the college tuitions, and everything else. We see that this is going to be a major problem. Now, it's not really that difficult to connect the dots here. The last time the U.S. had a major inflationary spike was in the 70s, and the head of the Federal Reserve at the time, Paul Volcker, was fired. So it looks like Fischer decided, I need to bail on this because I see much higher inflation coming, and the whole thing is going to be a complete and utter disaster. And we know that higher inflation is headed our way. The central banks are continually printing money, and we can see that there's a lot of countries out there that are moving away from the dollar, and once again, those dollars need a place to go. They're going to come back to the United States. We're going to see the devaluation of the dollar, which means precious metals will go up in value. We're going to see the cost of goods go up in value, or it's going to take a lot more dollars to buy those goods. So we can see that we are headed in this direction, and those people that are jumping ship right now, they're doing it for a specific reason because they understand what is coming. They already know what is coming. They can pretend that they have no idea, but at this point, we can see that the economy is deteriorating very quickly. We see the housing market, and it's already starting in Toronto, Vancouver. It's already starting in certain areas in the United States. And if you go outside of those 20 cities that Kay Schiller looks at and that the Fed pumps up, you can see that real estate is having a major problem right now. And as we move forward, this is just going to get worse. It's not going to get better. And it doesn't matter what the unemployment numbers say, because when you see many people out of work, and we know there's a lot of stores closing, a lot of people losing their jobs. And remember, when a part-time person loses a job, they might have been counted as a full-time job, but if they're not working a certain number of hours and getting a certain number of pay, they're not counted as losing a job. So what we see here is one gigantic manipulation, and we can see how they can manipulate the entire market. And this is what we're seeing right now. The entire system is cracking and falling apart right in front of our eyes, and this will accelerate. I know it started out very slow when we first started talking about this, but we can see how things are actually changing right now. Nothing happens overnight. The Fed, those who are in control, it takes a very long time to pump up an economy. They can't do it in a year or two. They need to do it very slowly. They need to build confidence. They need to make people think that everything is fine. And they do this on purpose. They're very patient, very methodical. And once they get to this point where everyone is feeling good, That's when they pull the rug out from under them, and this is when everything falls apart. This is why you need to be ready and prepared, because we're getting very close to that point. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.